Good evening. Welcome to Money Matters. I'm Charlie Shields of Wells Fargo Advisors, LLC, member SIPC. My co-host tonight is Patricia Dunn of Merrill Lynch, also a member of SIPC. And our special guest is Brendan M. Gilmore of MerCap Securities, LLC. So we're going to try to inform you about what we think is going on in the market. Stick with us. It's going to be a good show. Okay, well, let's start out, Pat, by talking about the theory that Sir John Templeton had years ago. He said, bull markets end in euphoria. Are your clients feeling euphoric right now? Is the bull market over?
Not at all. And they're also born on pessimism. I use Sir John Templeton's quote all the time. Actually, Charlie, according to the charts, we've actually broken out into a new secular bull market. The NASDAQ had its last peak in 1988, and it recently broke that high. So it has to be the unhappiest new bull market that I've experienced in my 40-year career.
Yeah.
Because people are still feeling the pain from 2008.
Yeah.
And people are very upset about how slow our economy has been growing. But technically speaking, beginning next year, things should be a bit better.
Well, my take is that there was a mistake made when Obama first took over of talking about shovel-ready projects and shoveling money into the economy before it was ready, and all that money sloshed into stocks and bonds, and we created this monster rally. And I suspect that 6 or 7 years is about enough time that the shovel-ready projects are ready now. And so I think when we start getting these big, expensive projects rolling, and I think we're ready to do that right now, that might give us another leg up in a bull market. What do you think about that?
I would hope so.
Yeah.
But I also think that since 2008, corporations have gotten so lean and mean that any kind of spark in the economy, and I think our corporations could really take off.
Yeah, and velocity of money may start picking up. Productivity has been in a funk, and we may start seeing productivity improve. And if all of those things start happening at once, people could be surprised.
Yes.
Especially when you consider that we got to have some euphoria before we're supposed to have the big drop in the market.
Exactly.
So let's see what happens. Okay, well, let's talk about international fixed income. Do you see any opportunities in the fixed income area overseas? There don't seem to be any good ones in the United States right now, unless you're willing to put some money in stocks and have some risk.
Exactly, exactly. No, I'm a little bit leery personally about the overseas debt markets because so many major countries are now into negative rates of return.
Yeah.
That you have to find something where you take on a little bit more risk in order to get your yield.
Okay, well, the thing we have to look for is the stimulus that we watch in the United States has created this monster bull market. It looks like they're finally getting serious about trying to create stimulus overseas.
Yes.
And if they do, then perhaps some of these closed-end funds that are all beat up, which have come down from 15 to 7. I'm not going to mention any specific ones. I want to remind our viewers and listeners to talk to their own personal advisor.
Correct.
We're not accountants, we're not lawyers, and we're giving them some things to think about. But some of these closed-end funds that have come down to 7 that have yields of 7 to 11%, if the economies over there fool people and do a little bit better, those could be a good place to shop.
Well, I'll leave that to you.
All right, fine. And so let's talk about another subject, stock market, Europe, and then let's talk separately about Great Britain with the Brexit going on. Do you see opportunities in either Great Britain or Europe right now, or are you focusing over in Asia?
Interestingly enough, Europe has got its problems. I do feel that the United Kingdom's going to come out of this okay, so I'm all right with that. I'm leaning more towards Japan and emerging markets right now.
Yeah. Japan's one of those countries I was talking about where they're really starting to get serious about stimulating their economy. And then, of course, they've got their population issue where they're aging, but the Japanese tend to be willing to work till an old age. So, you know, I think there's, because the stocks are cheap enough over there and they've been down so long, I think you're right, there's probably a pretty good opportunity over there. Okay, well, let's talk about the sectors in the U.S. The conventional wisdom right now is that consumer staples and utilities the PEs are pretty high, and be careful there. And then there's other people that are looking around to say, what's a beat-up area? Biotechs, for example, people are saying if Hillary gets elected, she'll allow them to spend billions of dollars to develop the new drug and then tell them they have to give it away. So biotech seem to be getting beat up. So what's your thought there?
Well, you're absolutely right on the consumer staples, the REITs, the utilities. They have extremely high PE ratios, and it's because of the dividends that they pay. And people have been going there because the interest rates on bonds are so low. And those interest rates are expected to remain low. So it's the sector that everybody loves to hate. But I really think there's some safety there, because as the Fed tries to raise rates, and now they're talking about December, if they do manage to raise rates, guess what? People who are dealing with negative interest rates overseas are going to come rushing here.
Sure.
It's a world of supply and demand, as you know, and it's going to force our interest rates back down again. So those sectors, consumer staples, REITs, utilities, I think are going to hold up despite their high PE ratios.
Okay, how about growth stocks, biotech specifically? Do you have an opinion on those?
Well, I'm in agreement with you there that a lot of it depends on who wins the election and how that comes to pass.
Yeah, you can almost see by looking at those type of stocks, you can see who the market thinks is going to win when the biotechs are getting hit. And I want to remind our viewers and listeners that they shouldn't be market timing based on this show. It's taped at different times in different areas. But in general, by the time November 8th rolls around, the market usually has adjusted and knows in advance what's going to happen, especially if it's a widespread difference between the two candidates.
Exactly. And I would put my money either in large cap value or large cap growth to see yourself through this period of volatility.
Okay. Let's talk a little bit about the Fed is threatening to raise interest rates as they've been doing for several years. They've already done it once, quite a while ago. They may do it again after the election. And so they control the short-term rates, basically. So then the question is, what are the long-term rates going to do? You know, if the people perceive that the Fed is going to allow inflation to come back, then long-term rates could start to go up the way they did in 1979. I'm not saying 16%.
No.
But, you know, rates could rise if they think they're being slow. If people feel like they're slowing down the economy by raising rates, then long-term rates will give us a clue by staying low, correct?
I would agree, yes.
All right. So do you expect, if the Fed does start raising rates a quarter point at a time, do you expect that to dampen the economy, or do you think the market's not going to care about that?
I think at this point the rates are so low the market is not going to care.
Sure. Edson Gould, an old trader, used to talk about 3 steps in a stumble, that the third time the Fed hiked rates is when you could expect a market correction, but I'm not sure that's going to play out if they're going up in quarter point hikes. If inflation starts to come back and the third rate hike, counting the one we've already seen and the next one, if they go up 0.5% or something to 1, that could shock the market for a while, but I still think that would just be a buying opportunity if we got a 10 or 15% correction out of that.
And especially in light of what could be the new secular bull market. So
Sure.
I agree.
All right, great. You got an opinion on gold or any other commodities?
Commodities, I think, are going to be hurting for a while. Energy will come back. It's not a question of if, it's a question of when. Some are calling for it to come back sooner, but I really think it's going to be a while before we start to see some exciting things in the commodities market.
Fair enough. Well, let's try to help one of our listeners. Tom Gallo of Exton says, what type of accounts are the new Department of Labor rules going to impact? What do I do as a retired individual? What do I need to know? Tom,
clearly you are an experienced investor because this is what is on everybody's minds right now, and there's articles in the Wall Street Journal on this every day. The Department of Labor came out with new regulations in April of this year that impact retirement accounts. They impact 401ks, IRAs, Roths, etc. That new law goes into effect in April of 2017. What the law says is that the industry must raise its standard of care for investors to being in the best interest of the client and the client's whole financial picture, as opposed to the standard that has stood since the 1940s, which said that the industry had to provide advice consistent with the client's risk tolerance. It didn't have to do anything to do with the rest of their life, just with their risk tolerance. So what in the end this is going to boil down to, that you as a retired individual, this is going to affect your retirement plans. And you will have two choices. You can either do your own investing on your own. You're solely responsible for all of your investment choices, good, bad, or indifferent. Or you can work with a professional, a wealth management individual who will be getting to know you and your essential needs, your important wants, and maybe your aspirational dream. They will provide financial planning for you, retirement planning, estate planning, legacy planning, and they will be doing everything in your best interest. You will be paying a fee as opposed to paying commissions, so that your professional gets a raise when your account grows in value and they take a loss when your account loses value. Now, these are going to greatly change the industry. I would encourage you to talk to your current financial advisor and find out how they're going to be dealing with the Department of Labor regs. You may find that they'll be leaving the industry. That is something that we're all expecting might happen. But this raising of the standard of care of the investor is not going to stop with retirement accounts. Expect next year to hear the same type of news coming out of the SEC to affect personal accounts. So at the end of the day, this change is good, and this change is good for the individual investor.
Thank you, Pat. Just to add a little bit to what you said, different firms may have a different policy about whether commissions can continue or what have you, but each firm will treat this the way they see it's appropriate. And as far as I'm concerned, hopefully you've always had an advisor who put your interests first, but now the law is going to enforce that. So the industry will be better for it. Thanks for your good answer, Pat. Okay, if you've got another question you want to send in, or if you need some help, just please send in your questions and we'll put up a quick videotape to tell you how to do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Bill Gilmore, thanks for coming in. How you doing?
Good. Thanks for having me.
Well, good to see you. We appreciate you being here.
Pleased to be here.
You've heard what we've had to say, and now you can add or subtract or whatever you want to do. So we'll talk to you for a while about this. First of all, talk about your background and experience, if you don't mind, so people will know what a
Sure.
broad-based background you have.
Well, I've got 40-plus years in the investment business, mostly with Wall Street, the Wall Street banks. I hope you won't hate me for that. I started out with Brown Brothers Harriman. I spent 8 years there. I was investment officer. I was an officer of the firm. I was a portfolio manager in the investment advisory department, and actually spent a couple years in their foreign investment department in addition. I spent 26 years with beginning with Bank of New York, beginning with Mellon Bank, which became Bank of New York Mellon. I started originally to actually start an investment advisory boutique within the trust department for Mellon Bank. I wore a variety of hats over the years. I ran an international fund out of San Francisco for a couple of years. I worked at Harvard Business School with Professor Jay Light building asset allocation models for the Bank of New York Mellon. I ran the wealth management business on the West Coast out of Los Angeles in the late 90s. I was responsible for the Washington, D.C. office, building that out, starting that. I was a senior investment officer for the Mid-Atlantic region in my last position before I retired. But during all that time, I always had clients, and I always was involved in managing their affairs and their monies, because and one of the things I said to the leadership at the firm was, the problem with investment people is when you promote them, you take them away from working with the client. And I think that's very detrimental, because they lose sight of what's really on the minds of clients, and what are their concerns and their fears, and how do you relate to that? You get this kind of ivory tower attitude. In terms of academics, I went to Pace University in New York City. I have a bachelor's in economics. I also did additional work on a graduate level in economics. Decided I didn't want to be an academic, so I went to business school and I took a master's degree in finance with an emphasis on investment. I spent my whole career working with clients.
Okay, so you've seen a lot of ups and downs in the market in 40 years. Pat, do you have a question?
Yeah, I do. So I appreciate your keeping clients as you were working on the other side of the fence, if you will. And now in retirement, you've decided to pursue working with clients. Tell me what kind of clients you work with.
Sure. Well, I always say working with clients was the only fun part of the business. Managing people was not. I left when I retired. I retired. I really didn't see myself not working anymore. And frankly, I started this practice I have because I'd be doing it anyway. I'm addicted to the investment business, and I love looking at. I'm a macroeconomist by training, so I love looking at broad trends across the world and in our economy, and working with people. And I've been doing this. I also have 2 children in high school, so I still have college fees to confront with.
All right.
Yeah. Well, when a client comes in to see you and they're transferring into you, how do you set the whole process up with a client to reassure them what you're going to do and get them comfortable? Right.
Well, to begin with, I think first of all you have to have just have a discussion with the client and just kind of get to know them, and listen to what they say, because invariably I think many times clients feel that they have to answer certain questions a certain way. I can remember talking to a client one time at $5 million, and it was clear, talking with this guy, he was terrified of the stock market.
Wow.
And he said to me finally, he says, "Do I have to buy stocks?" My answer was no. You don't have to do that. Not if you don't think not if you can't sleep at night.
Right.
And that's the one thing I try to say to clients is, if my activities are keeping you awake at night, then I'm probably not doing the right job.
Yeah.
So I want to get to really know the client, get to know their circumstances, and then with that, it's an education process. Our role as advisors is to help educate our clients as to, how certain asset classes act and what kind of, now granted you don't have a crystal ball, but generally what happens with bonds if interest rates go up? Well, bond prices tend to go down. You know, if the economy is growing and corporate profits are increasing, stock prices tend to go up. And so these are kind of the areas you want to give broad sense to and get a sense of how the client can be positioned, and then what is he trying to accomplish? What are his goals and objectives? And what are the opportunities and what are the negatives? You know, one of the things, all of us are dealing with clients who are getting older. And one of the things clients have to realize is you know, that, you know, if you're 20 years old and the market goes down 20 or 30%, you can survive. You know, that's not a big deal. If you're 60, as we saw in 2008, how many people's 401ks were devastated, right, and how many people's retirement plans were pushed back or eliminated because of that. So these are the kinds of things you have to determine with the client, and you have to come to some sort of agreement as to how we're going to progress, how we're going to go forward with this strategy. The other thing is, I think it's crucial in working with clients is communication. You know, I talk to clients, I want to meet you on a regular basis, face to face. I want to ask questions that may be the same questions, but things change. And we want to be sure that what we agreed to 6 months ago or a year ago is still the appropriate you know, position to take. Sure. You know, I used to give the analogy, you know, if you were sailing a boat from New York and you wanted to go to England, if you didn't check your compass every few miles, you may find yourself in Africa or the North Pole. Sure. And that's the same thing. We have to constantly check our course and make sure we're on the right path.
Okay. All right. Well, with the outlook for interest rates right now, and an emphasis on working with retirees or pre-retirees, how do you provide for income? Well,
historically, investors looked at fixed income for two things, both for income and for safety. And I think at this juncture, where we are in our economy and everything, I think neither one of those things work. Right. I think that there's no income, we all know that, and I think we all agree that if interest rates do start going up, or we should say when interest rates start going up, bond prices will be impacted. So what I do with many clients is I look at their IRAs. If they have a 401k, they roll into an IRA. An alternative to a bond portfolio would be an annuity. The advantages of annuity in this environment, one is that, you know, you get a guaranteed annual roll-up for withdrawal purposes, and then you get a guaranteed income stream for the balance of your life or for yours and your wife's. One of the things that annuities can provide is if you yourself have an IRA, that's for your life. But you can take a portion of that and you can purchase an annuity for 2 lives. I work with a client. He's married. He's still working, but he took an in-service withdrawal. We purchased this annuity for 2 lives, him and his wife, so that regardless of, as long as one of them are alive, that income level will always be the same. And the advantage of annuity is you get a guaranteed rate. So in other words, if the amount's $20,000, $30,000 a year, whatever it may be, that will never go down, regardless of what happens to the principal of your annuity or what happens to the stock market. So I talk to clients all the time about the purpose of buying an annuity. The number one purpose is peace of mind.
Okay, well, the problem with the stock market now is PEs have gotten up to relatively high amounts in the U.S. historically. You know, 18 or 17 times earnings is pretty lofty, but on the other hand, most people have to have some money in the stock market in order to get a 4% average return to be able to put the food on the table. So how do you go about explaining the risks and rewards in equities and how they should go about structuring their portfolio?
Well, you know, there's no question that if you want to keep pace with inflation and you want your assets to grow, you have to be invested in risk-based assets and stocks. Actually, looking at the valuations for stocks today, if you look at S&P multiples right now, they're at about 16.5 times earnings on a forward-looking basis. If you look at the 25-year average for S&P multiples, it's only 15.9. So you're about a third of a standard deviation away. You're modestly higher. If you looked at the Schiller index, that's about 26.5, and their 25-year average is about 26.
Yeah.
So the way I would describe stocks is being fairly valued. But then the question is, where do we go from here? And in my sense, what you have to look at is, number one, the economy. Is the economy expanding or contracting? And then number two is corporate profits. Because at the end of the day, what drives stock prices is profits. And what we see in the market today is, we've gone through 5 quarters of declining S&P profits, primarily because of oil prices. The rapid decline in oil prices had an impact it had on oil companies, but also to a lesser extent, the rapid increase of the dollar in late 2014 and early 2015. This now going into we're getting third quarter profits starting this week. The expectation is this will be the first quarter in 5 quarters where we actually see higher earnings, and the expectation is that will continue for some time. So I think that you could look at the equity market and see the market as being a reasonable place to invest. When you look around the world, I think to your point, emerging markets are probably you have better long-term growth opportunities. However, I would also caution you is that a lot of these economies are commodity-based economies, and I agree with you that the outlook for commodities is still muted. I think Europe is 30 or 35% under value relative to the U.S. I think they're
P's are 12 over there.
They're about 3 years behind in terms of what their monetary authorities are doing relative to the Fed. So I think there's a lot of value there. And if you're looking for income, a lot of those European companies pay very generous dividends, and so that's something that, again, you have to consider. But again, you don't know when these markets will turn or what it's going to take to turn these markets. So there's still a lot of uncertainty out there. So it's not it's a dangerous world.
Well, Brendan, I couldn't agree with you more. Between energy and the dollar, that was a headwind at the beginning of the year.
Yes.
It became neutral during the summer, and now they think it's going to be a tailwind going into the fall.
We can hope.
We can hope.
Okay, so do you feel like asset allocation is a method to use and take the emotion out, so that once a year, every 6 months, you look at what's gone down and what's gone up and just move some money on the margin? Or do you try to overweight certain areas of the world where you think there's an opportunity? How do you go about that?
Well, for a number of years, I've been a strategist in working with the Bank of New York Mellon in my capacity there, and I've worked, as I said, doing asset allocation up in Cambridge. And then if you look at there's a matrix chart, which I think we've probably all seen, which shows all the asset classes every year and who's the first and who is the last. And I used to always show that to clients, and I used to ask them, I said, what conclusion can you come from looking at this? And they'd look at it and scratch their head, and I finally said, the conclusion you can come to is you can't draw a conclusion. There's no rhythm or rhyme or reason to this, so that it makes the most sense is to be diversified and have a piece in every bucket. And that I think both is over periods. I work with investors. I don't work with traders. I'm not I don't have any capacity to help people there. Over time, what we see is a diversified asset allocation strategy of quality investments will provide a very competitive rate of return, and more likely as not meet what the client's needs are, and at levels of risk that will allow them to sleep at night.
Okay, well, it's been an interesting show. It's gone by fast. We appreciate you being here, Brendan. And Pat, thanks for participating. Next week, we've got Paul Becker, who's the CEO of DDP Roofing. And that might sound like a strange subject for a investment show, but we find that Things like what's going on in the economy can be determined sometimes at the micro level by talking to a guy like this and finding out how's business. So stick with us next week. As far as we're concerned, your money matters.